Welcome, everybody, to Stock Talk with Nico Criticos. Today, we're going to be going through Draftkings stock and doing an in-depth analysis to see is this stock a good stock to buy or not. So, Draftkings is in the business of iGaming, sports betting, fantasy sports, and those are the main ways they make their money. So, over the past year, the stock is down from its highs of $70 to now down to $28. And today I decided to make a small position in this. I do believe there's a chance it could fall more. I wouldn't be surprised if it got down to $25, but I thought it was still a fair value at where it was today. And we're going to go through all the reasons why I feel a little bit bullish on this stock going forward. So first thing we're going to do is look at my stock market checklist, and number one is the stock down or oversold, and I believe yes it is. The stock's down over 40% on the year, and so that definitely gets a check. Next up, we have revenue and net income. We can see revenue has been increasing year over year, but net income has actually been getting worse. They've been losing more and more money every year, and in 2021 they're expected to lose over $1 billion again, so that's definitely not a good sign. Next up, we have price to sales and forward price to earnings. And for price to sales, it's a 9, which is pretty healthy, especially for a company who is growing revenues 100% this year and then 50% next year. A 9 is extremely cheap. Okay. But once again, they're not profitable. So the price to earnings they don't have one. So it's not very good. It doesn't look like they're expected to be profitable anytime soon. So that's that. Then we have, is the company innovative and do they have a moat? I put yes. I do believe what they're doing is innovative. I think they have a moat for several different reasons, which we'll get into in a minute from now. But they have lots of different streams of revenue, and they have very high market share. They have a very loyal customer base, and I think I would count that as a significant moat in their industry. Are they innovative? Maybe in some ways. I mean, I think that since the industry they're in with sports betting and with fantasy sports, both of those are pretty fast growing industries right now and very popular. So, and a lot of states are, only about half of the country has legalized it. And I know they were talking about expanding into other countries like Canada as well. So they're definitely, I think they are, at the forefront of a growing industry, and they are doing some innovative things. Another way they're innovative is through doing their NFT marketplace they're coming out with next year. They partnered with Polygon, which is a smaller crypto that's built off of the Ethereum blockchain network. And that's supposed to give some more credibility to Polygon, and it's allowing DraftKings to make this NFT marketplace next year. So I think that is a very innovative thing. Then once again, the number 7 is the growing industry. I put yes. The online sports betting industry is expected to grow at a compounded annual growth rate of 10% for the next 3 years. And I think they're in a good position to capitalize on that. Then we get down to some more financial metrics. Return on invested capital is negative. Profit margin negative. Healthy cash flow, no, because it has not been good over the past couple of years. It was 2017, 18, and 19. I think it was negative. And then out of nowhere, it was 2.7. I think that was because they did some acquisitions. I know they acquired Golden Nugget casinos, and they got 2.7 billion of cash inflows like a little over a year ago. And then now that's the operating cash flow for the past quarter was like 1.8 billion. So it does not look healthy. They're losing lots of money, and it looks like they're spending most of it's going on things like marketing. So, I mean, it's kind of understandable. Most companies that are in this type of industry that are growing fast, and they prioritize revenue growth over any profitability, which that makes sense a lot of times. In order to compete with this is a very competitive industry. So in order to get an edge over the competition and, maintain market share, you kind of need to spend a lot of money, but it is what it is. So then the last one is diverse revenue streams. I put yes. They have fantasy sports, they have sportsbook, iGaming, and then their business revenue. They make money from advertising. So I think all really the fantasy sports, the sports book, and the iGaming, those are three pretty strong segments to make money through. And I'm going to give that a yes, because I'll count that as diverse revenue stream. So then we get to the balance sheet, which is not very good either. They have more long-term liabilities and assets, not good. They do have some more short-term assets than short-term liabilities, and then they have the equity again has been decreasing. So that's not too great of a sign. How I said, even though this company is growing fast and a lot of times it's acceptable for them to not be profitable at the beginning, but they still, investors want to see some sort of progress being made with profitability and with the equity on the balance sheet. So they kind of have failed at that. And then next up we have, is the company doing a share buyback program, or do they pay a dividend? No, neither of those. I think they issued 6% more shares this year, so they diluted shareholders just a little bit. And then finally, is big money interested? Yes. I think ARK Invest, they're one of the most popular for this one, because they have $800 million invested into this. And then Vanguard, I think, has a little over $1 billion. So that's a good sign. When you see the big money putting money in, and that's always a good thing too. But they only got 8 out of 16 criteria, and we needed a 10 to be considered a buy. So this is where it's kind of interesting, because I'm not 100% sold yet on this company. I just believe that I think it is kind of undervalued at $28. So that's why I took a little bit of I bit off a little bit today, but we'll see what happens. Now, getting into the positives, I have Polygon, as I talked about earlier, is utilized for DraftKings NFT marketplace, which they're coming out with in a couple months. And they're also partnered with the NBA, the NFL, and they entered a commercial agreement a couple months ago with Golden Nugget Retail Casinos, with Landry's, and the Houston Rockets. So this also gives them access to large customer databases and market access rights. And so, I mean, that's another positive thing when you see them acquiring other companies and they're like the official partner with the Houston Rockets. They get to make money through, all those different ways with the Houston Rockets and everything. So that's another positive for this company. They also have 32% market share in their app downloads, and I'm pretty sure they're number one. I think it's them and FanDuel right now are at the top, but that's a really strong thing to have. 32% market share is pretty good in this competitive of an industry. Then we have the stock is at a 52-week low. That's also a positive sign. How I said, I do believe it could go lower, because from the time it IPO'd at $10 a share a couple years ago, and then it went up to $70. So anywhere in this $20 to $30 mark, I think, is more of a fair value for the company, but it could definitely go back down to 20. So we'll just keep an eye on it. And then finally, we have this year they became more vertically integrated, and they started developing more in-house technology, which they claim is going to help with their profitability moving forward. They also claim that their profitability will get better because of it takes 2 to 3 years for a new state that legalizes betting. It takes 2 to 3 years to make that state profitable. So we'll see what happens, and hopefully they can attain profitability within the next couple of years. For the negatives, we have it is very unprofitable. This is a highly competitive industry, and if they keep increasing the number of shares, it could continue to dilute the shareholders in 2022. This graph is just explaining the different ways DraftKings makes money. We can see the big one is the fantasy sports. When you use the fantasy sports apps, you have to pay a 10%. It says 10% of the fee going to the company, and the remaining 90% gets put into the prize pool. So that's a big source of revenue for them, as well as the sports book, the sports betting app makes money, and then the iGaming, which is like casino games and blackjack and stuff like that. And then finally, they make some money from advertising as well. But yeah, those are the main ways that they can increase their revenue. Now, this is showing the market share compared to all these companies. So as you can see, this is a year ago, September 2020. DraftKings had 33% market share. FanDuel had 30%. I think FanDuel was getting a little bit. If you look at this graph, this shows you FanDuel down here is the blue. FanDuel has been gaining market share over the past year, while DraftKings has been losing a little bit. And of course, that's normally how it works when you have like all these different, you can see all these different competitors getting into the space. And I think there's more than this. There's some that are missing. I know Win Resorts, Win Bet, they're on here too. They started up a couple months ago. So this is a very competitive environment that they're in, but they're maintaining pretty high market share. And then what happens is once this industry consolidates a little bit within the next 2 years, let's say, there's only going to be a couple big players. So let's say it's FanDuel, DraftKings, and BetMGM. Let's say those are the top three. Well, then they're each going to have about 33% market share. So as long as DraftKings can, they're not losing too much. If they keep losing market share, then that's a bad sign. But as of right now, they're doing pretty good with that. So yes, those are my reasons for why I bought the stock today. We'll see what happens. If it goes down more to like $25 or $23, then I'll buy a little bit more probably, but I'm going to be paying close attention to what they release for numbers this upcoming quarter in a couple of weeks now for Q4. And I want to see some improvement. If I don't see improvement with profitability or with the balance sheet, then I might consider selling. So yeah, we will see what happens. I think it's very interesting that they're getting into things like the NFT marketplace. I think that could be a huge driver for them. That's very innovative. So we'll see what happens. And yes, thank you for watching, and comment down below what you think.